Hey guys, it's Steve Lamoth. We're already into March and almost done with the first quarter, which is just insane to me. This year's just flying by. But I had a recent phone call with a first-time home buyer, and it really brought up to me the topic of PMI. And just to give you some context, the call was about a young gal who had considered buying a home 5 years ago and decided not to purchase then because she did not have enough money saved to get rid of PMI. And in talking to her, I explained my philosophy on PMI and why I think it's important to not worry about PMI and the challenge it creates for people because it keeps them from wanting to buy. Now, how does PMI work and why it's not important when making the decision to buy is a really important topic to think about. Now, imagine that gal, if she had bought a home 5 years ago and was paying her PMI, at that time, I think it was like $180 a month. Imagine how much equity she would have 5 years later, and she probably would have been able to drop her PMI after just 2 years, right? So first things first, what is PMI? PMI is a mortgage insurance. It's called private mortgage insurance, and this is a requirement for lenders to have if you're putting less than 20% down. And in a nutshell, it's basically an insurance policy the lender pays and passes that cost to you so that if you default, the lender gets paid back for a bad loan, right? This came after 2008. So those policies can range anywhere from $100 a month to $300 a month. It depends on how much you're borrowing. So if you have 5, 10, 15% down, you're gonna have PMI. The interesting thing about PMI, on a conventional loan, the PMI can be dropped once you have hit 20% equity. So let's say you put 10% down, and then 2 years later, your loan to value is 20% equity, meaning your property has gone up in value, you've made payments that have reduced your principal, and now you have 20% equity. You can actually stipulate to the lender and request an appraisal and get your PMI dropped. So if you were paying $200 a month, and so it's basically costing you $2,400 a year, after 2 years, you've paid $4,800, and now you're requesting that the PMI be dropped, your payment goes down $200 a month, and you have 20% equity in the home. Versus waiting and not buying and trying to save up your 20%. In most instances, I have found that people, as they're trying to save up to 20%, things happen, right? They have to buy a new car, they tend to eat out, right? They're not financially disciplined enough, and it takes longer, 5 years, 10 years to try to get to 20% than had they just bought the home 2 years, 3 years, 5 years ago and bit the bullet and just not cared about that little extra charge and started building equity right away. Now, there are some requirements for FHA loans. You will have to keep your mortgage insurance. I still recommend to people, if you're buying with an FHA loan, even though PMI is required, you can't get rid of it. You can refinance out of it later on if you hit 15, 20, 25% equity. So in a nutshell, PMI is a non-concern for me other than, can you afford the monthly payment? And are you financially secure enough to own a home? By no means am I recommending to people to just buy a house just because, even if you're on the edge financially. But PMI is not something that should factor into your financial equation, whether to buy or not, because over the long run, PMI will sit there probably 2 to 5 years, and the cost of PMI versus the cost of not buying, the opportunity cost you lose by not buying and trying to wait, is drastically different by tens of thousands of dollars. As always, reach out to us at homesbyelevate.com or call us at 916-436-SELL.